Hi there, Happy New Year and welcome to 2023. 2022 proved to be awful for most investors, with very few asset classes escaping some pretty major reductions in valuation over the year, particularly fixed income or bonds, which had some of the worst years on record, driven mainly by persistent inflation and central banks cranking up interest rates in response. Equities had a pretty rough ride as well, with the NZ50 index down around 12%, the S&P 500 in the US down by about 20%, the Nasdaq down over 30%. Commodities were one of the few bright spots for the year. Commodities tend to perform well in response to inflationary pressures, and a lot of commodities have seen price spikes as a result of the Russian invasion of Ukraine. The Australian stock market, for example, ended the year only slightly down by comparison to the rest of the world, and the UK FTSE, which is quite commodities heavy, actually managed to post a small gain for the year, although with some pretty significant volatility along the way. Today I wanted to talk in a little more detail about real estate though. It too suffered last year, with listed real estate investments in New Zealand down 22% as a sector, easily the worst performing of the main asset classes in New Zealand. Australian and US listed property was down by a similar level, and privately owned residential properties in both countries have seen some of the most significant losses of value in the last several decades. Given that residential real estate has been such a significant part of so many people's wealth creation plans here in New Zealand, whether that's by design or by accident over the last decade or so, I thought it'd be worth looking in more detail at where we're at now, what some of the driving factors of valuations are at the moment, where things might head over time, and what you can or should be thinking about moving forward from here. Before we go any further, I do want to state for the record that while I am a financial advisor, none of what I'm talking about today should be considered personal financial advice. So I've got no idea about the specific circumstances that you watching this may be in, your risk tolerance, your capacity for loss, your ultimate targets, goals, etc., none of it. So this video is intended to give a broad perspective on things only, and the right course of action for you might be totally different to someone else's, even if you're in the same market. So keep that in mind. Now, if you do want personal advice, if you want someone to discuss your specific circumstances with in detail and give you personal recommendations on what you should do, then well, that's what we do. So find our website, links will be down below, book a free consultation, and we can take it from there. The Real Estate Institute of New Zealand recently published their house price index data for December 2022, and that showed that New Zealand's house prices dropped by nearly 14% in the last year. Auckland's been hit harder, with the house price index there down around 17%. Now, it's worth mentioning that the REINZ house price index is exactly that. It's an index, so it's adjusted for factors such as the mix of properties being sold at any one time, so that the results aren't skewed by outliers. So if a bunch of multi-million dollar properties are sold in a short period of time, for example, then they won't skew their house price index up. So as far as a single metric can give a true indication of where house prices are for a broad market, it's probably the most useful measure we have, and it's one that's widely used and trusted. Okay, so the big implication here of a 14 to 17% drop in house prices is that for a lot of people who purchased property in New Zealand in the last 1 to 2 years, geared up to 80%, they're probably starting to see the value of their property decline to the point where it's only worth slightly more than the amount of debt that they've taken out to buy it. And if prices continue to fall much further, there's a real risk that they'll be underwater, which is clearly not a comfortable spot to be in, and is likely to starting to cause real concern for some households, particularly with interest rates climbing and borrowers staring down the barrel of potentially significant increases in mortgage payments this year. It's worth saying at this point that the best defence against a situation like this is stable income and stable employment, and that's one thing that we as a nation have in spades right now. The unemployment rate is at historic lows. Jobs data due over the next week or so is expected to show continued tightness in the labour market, and that unfortunately presents a real quandary for the Reserve Bank, as labour cost and supply disruptions due to the lack of staff are both significant driving factors in the persistently high inflation we've been seeing over the last year or so. And that brings us onto the topic of interest rates. One of the overarching driver of property prices here in the last year has been the cost of and access to mortgage debt. Interest rates have been climbing at a rapid clip in the last 12 months as central banks globally have been moving their cash rates higher, which has been in response to persistent increasing inflation. If we look at central bank rates for a range of developed economies, we can see just how stark this change has been. And it's clear that the current situation we're seeing is a major shift away from the loose monetary policy conditions of the past couple of decades. Interest rates have a direct or indirect impact on valuations of everything, which is logical. If you're borrowing money and your loan payments are higher, then you're going to be willing to pay less for an asset. Central banks push interest rates higher through their official cash rates and their balance sheet operations in an attempt to combat or reverse inflation by reducing demand. By increasing the cost of debt, less people borrow, more income is spent on debt servicing, and individuals and businesses reduce spending on goods and services as a result. Individuals might reduce consumption of discretionary goods and services or seek to substitute spending for cheaper alternatives. Businesses do the same, or they may look to reduce costs by reducing hiring or even laying people off completely. So if we take a quick look at how retail one-year fixed mortgage rates have changed in New Zealand over the past year, this is the standard one-year rate from one of the main banks. The rate can vary by a few basis points bank to bank, but this is pretty representative of the average at any one time over the past year or two. And we can clearly see the increase in the last 18 months from a low of 2.19% mid to late 2021 to today's highs of around 6.4%. To give you a sense of the potential impact to household cash flows, consider a household in Auckland that took out an $800,000 mortgage in January 22 to buy a $1 million property, which is roughly where the average house price sat around then. If that mortgage in Jan 22 was fixed for a year at 3.4%, it'll be renewing now at around 6.4%, which is a 300 basis point increase. When that mortgage was first taken out, payments would be around $3,500 a month, with around $2,300 of that going to interest in the first month. On renewal a year later, that's going to increase to around $5,000 a month. So an increase of close to $1,500 a month, with over $4,000 of that going to cover interest. For the vast majority of households out there, that's a material increase and will have a big impact on household cash flow. Around half of mortgages in New Zealand expire in the next 12 months, which will have a dramatic effect on households' ability to spend. And in an environment like this, with debt servicing costs significantly up, people are clearly willing to spend less on acquiring property. Access to credit has been problematic in New Zealand over the past year or so as well. Banks assess loan applications using test servicing rates, so it's a higher interest rate than the prevailing market rate, to have some certainty that borrowers will be able to continue to make payments if interest rates rise. As interest rates have gone up, so have these internal test rates, reducing the number of people who are eligible to borrow or reducing the maximum amount that they can borrow. And in addition to this, the Consumer Credit Contracts Act passed in late 2021 introduced a range of requirements on and penalties for lenders, increasing the risk to them when they're lending to more marginal borrowers. So both issues have played a major part in reducing the number of potential buyers able to access mortgage funding. Currently, there's limited evidence of homeowners reaching significant levels of distress, but given that half of the mortgages in New Zealand are on comparatively low rates, it's likely that homeowners with debt still have some pain to come, and that pain's likely to translate into further downward pressure on house prices as buyers pull further back and more owners consider selling. Now, it's not a foregone conclusion, of course, that higher rates mean higher distress levels. Households historically have gone to extreme lengths to stay in their homes and keep servicing mortgage debt. Discretionary spending goes out the window. People substitute for cheaper goods. They work additional hours. They start renting out their spare rooms to boarders. They'll even, they'll look for help from family or friends to keep it afloat. Anecdotally, we're certainly seeing some evidence that this is starting to happen, but as more as a preventative measure than out of necessity today, so people can see what's coming and want to be prepared. Let's have a look at the interest rate outlook from here. And let's start at looking at what the banks are saying. So they're all in the same ballpark with their estimates of the official cash rate peak sometime in 2023 with a terminal rate of between 5.25 and 5.5%. Forecasts do diverge a little at that point, some expecting rates to flatten off, others expecting economic conditions to have turned sufficiently for rates to start coming down again. There's some clues we can look at to see what markets broadly think of the future, bond market yield curves, for example. So if we look at the yield curve on New Zealand government debt, we can see that rates being paid to investors at the moment actually go down the longer the term of the debt. So that yield curve is inverted. Now, bank funding comes from a range of different sources, so the NZ yield curve isn't the only sort of source of truth here. But we do see a common theme when we look at the US yield curve. The message at the moment is that investors think that inflation and interest rates will be higher in the short term than in the long term. Now, I think one of the best places to look to get inside the mind of a big bank is the rates that they're actually prepared to offer to borrowers today. Now, if we look at ASB and Westpac, they're making some clear statements with their fixed terms at the moment. Both banks' retail mortgage rates are now inverted as well. Basically, you'll get a cheaper rate from these two banks if you commit to a 2, 3, 4 or 5 year term than you will for a 1 year term. Now, I'm not going to be too committal around what I think prices are going to do. Frankly, I've given up a long time ago on forecasting what the New Zealand house price market is going to do, and a lot can happen in a short period of time. The macro environment and rates can move very, very rapidly in response to events. But there's certainly a strong belief in market that rates will start to ease by the end of the year. Markets are betting that central banks will get on top of inflation and the economic output will drop as a result, and we'll see recession as a result of that. Now, the Reserve Bank in New Zealand has specifically stated that they expect that to happen, or they believe that will need to happen to contain inflation. Now, a recession on paper may not be a problem for many or even most people. As I said earlier, one of the best hedges against inflation and worsening economic conditions is a job. And pretty much right now, anyone who wants a job can have one. Now, this could well change during this year, but given that the labour market's starting at such a historically strong position, it would take a big change in the unemployment rate for things to get really bad. So where does this leave us on the house price front? Well, interest rates are a major factor in pricing, but they're not the only factor. Immigration, for example, is higher than had been expected, meaning more potential buyers. So far, we haven't seen panic selling on any meaningful scale. Inventories and turnover rates are still low, which suggests that vendors are holding out on price for now. Construction costs are still experiencing higher levels of inflation, which mean constraints on new building. Even if consents are up, properties still need to be built. An election this year and a potential change in government may mean reversal of tax policies that have made owning investment property less attractive here in New Zealand. So while there's broad downward pressure due to rising interest rates, there's a number of factors that are pushing back. Ultimately, in my view, price trajectory from here will come down to the resiliency of households to higher debt servicing costs. New Zealanders prize their homes, and mortgage borrowers in New Zealand can go to extreme lengths to keep servicing their debt, unlike in, say, the US, where borrowers are much more likely to walk away from debt. If households contain spending, inflation continues to moderate, interest rates flatten off or start to decline, construction backlogs start to increase, and we don't see a wave of forced sales, then it's likely that we'll see the house price index start to bottom out and potentially recover over time. And while the opposite could happen, there's early signs that inflation's starting to moderate globally, which could indicate a turning point is near. So if you've found this useful, please consider subscribing. We're aiming to publish more content like this over the year with a mix of general sort of market and commentary and updates and general tips and tricks on managing your finances more effectively. If there's any topics in particular that you're interested in seeing, I'd love to hear from you. Please let us know below. And of course, please reach out to us through one of the links below at any point as well if you want to have a more detailed conversation about your situation and how we might be able to help you out. We don't charge for an initial conversation, and of course there's no obligation as well. Thanks very much, and see you next time.